Welcome back to Taxes Made Simple. I'm your host, Karlton Dennis, and in today's video, we're going to discuss vehicle deductions for LLC owners. I have a lot of LLC owners, I have a lot of S corporation owners, I have a lot of C corporation owners, but the big question that comes up with entrepreneurs is whether or not you're going to have to allocate your vehicle underneath your business in order to receive tax deductions. If this is your question, I'd look to solve that for you today. So let's dive in. All right, guys, it's a pleasure to be back with you. If you haven't taken it upon yourself, I'd love for you to join the Tax-Free Wealth Challenge. The challenge that I'm running is going to be from June 27th through July 1st, and it's a way for me to coach you and be your tax strategist. If you haven't taken it upon yourself to join the Tax-Free Wealth Challenge, I'd love for you to join that challenge so I have an opportunity to help coach you over these tax strategies that I leverage on my YouTube channel. We'll be going over advanced coaching as well as some of the basic stuff, but most importantly, you'll have access to the recorded calls, but you'll be able to go back later and always refer to this information or go over this information with your CPA or tax professional. Now back to the video. All right, guys, so one of the things in which I want to discuss is why do most business owners have a confusion around whether or not their vehicles should be underneath their LLC or if their vehicles should be underneath their personal names. The main reason why there's so much confusion around this topic is because many business owners understand that they bought their vehicles in their personal names before they became business owners. So there's confusion around how to get the business vehicle to become a business tax write-off that was personal before. And that's completely fine. It's okay to have confusion around this. When you're getting started in business, there are certain things that are just not very obvious to the business owner. There's not very obvious answers online either. So I want to make sure that this channel is a way for you to get that tax education that you're looking for. Some of the not obvious questions that you have is around how do I make sure that I'm actually able to write off my car if I purchased it in my personal name. So we're going to go over the 3 rules to make sure that you can write off your vehicle underneath your business, whether you purchase the vehicle in the name of your business or if you purchase the vehicle in your personal name. So let's talk about it. All right, guys, rule number 1 is making sure that you understand the differences between actual versus mileage. So what we're going to do is we're going to talk about what is actual and what is mileage as it comes to our taxes. But I first want to jump online so we can read through the updates that the IRS just gave us around the mileage deduction. The IRS just put out new updates as of June 9th, 2022. So if you're watching this is new information around the vehicle mileage deduction. So let's tune in. The government states in order for us to use a business vehicle inside of our business, the vehicle has to be ordinary and necessary for the business owner in nature, and the vehicle needs to be used for more than 50% business use. Now, most people are like, Karlton, how is the IRS going to know how much I'm using my car for business purpose? Like, are they really requiring me to have a clock sitting in my car with a stopwatch that's just tracking the amount of time that's personal use or business use everywhere I go? Like, how are they going to ever know? And how is it going to be broken down to a specific percentage? Like, how is it going to be 62% or 78%? How would I know that, Karlton? Why can't it just be like basic, like 50% of the time is personal, 50% of the time is business? The reason why is because the IRS does require you to document your business use. In the event of an IRS audit, you're going to have to substantiate records. And if you do not have any records showing the business being in use for business, you're going to get into some trouble when you try to claim that deduction on your tax return. So the way in which we can show that our vehicle is actually being used inside of our business is having some type of mileage tracker. Most business owners are taking either actual or they're taking mileage on their tax returns for a tax write-off. You as a taxpayer have the choice to choose actual versus mileage. Now, the IRS has made some updates on their website letting us know about the new mileage rates. Let's look at them. All right, guys, so if you see right here, the IRS announced on June 9th that there is going to be an increase in the optimal standard mileage rate for the final 6 months of 2022. So I want to make sure that I really point this out. They said the final 6 months of 2022, not the entirety of 2022. So key point there. Now, for the final 6 months of 2022, the standard mileage rate for business travel will be 62.5 cents per mile. This is up 4 cents from the rate effective at the start of the year. The new rate for deductible medical or moving expenses is also up 4 cents and will be 22 cents. In recognition of recent gasoline price increases, the IRS made this special adjustment for the final months of 2022. The IRS normally updates the mileage rates once a year in the fall or the next calendar year. The IRS is adjusting the standard mileage rates to better reflect the recent increase in fuel prices, said IRS Commissioner Chuck Reddick. Okay, so the IRS is realizing, okay, there's been some impacts on the economy with the fuel rates. We need to do something about it. And the commissioner said, you know what, we're going to increase the mileage deduction by 4%. While fuel costs are a significant factor in the mileage figure, other items enter into the calculation of mileage rates, such as depreciation and insurance and other fixed and variable costs. So we're going to talk about that, guys. The optimal business standard mileage rate is used to compute the deductible cost of operating an automobile for the business use in lieu of tracking actual costs. Let me say that one more time. The optimal business standard mileage rate is used to compute the deductible costs of operating an automobile for business use in lieu of tracking actual costs. Taxpayers always have the option of calculating the actual cost of using their vehicle rather than using the standard mileage rate. Okay, so there we have it. There is new IRS rulings that says 6 months of the rest of the year, we get this upgraded mileage deduction. It's going up by 4 cents. We get 62.5 cents. Then they later say taxpayers have the option of calculating the actual cost of using their vehicle as opposed to using the standard mileage. When I look at this information on the IRS's website, I see a bunch of information, not a bunch of direction on what you should be doing. And the reason why I point this out is because the IRS is here to share information with you. That's what they're doing in this article. They're not here to tell you what to do. And as a taxpayer, it's up to you to take control over your own taxes to figure out what you should be doing. If you're watching this right now, this information got released in the month of June. When do people file tax returns? April 15th. When do you need to make a decision on this? Probably right now. Why? Because we have 6 months until the end of the year to decide if we're going to be tracking our mileage. So you as a taxpayer who's watching this video has to take it upon yourself to realize you're the one who's responsible for tracking your mileage, not your tax accountant. And come tax time, it's up to you to have your actual expenses and your mileage so your tax accountant, someone like me, can take that into consideration to figure out what's going to be the bigger deduction. Now, one of the things that I wanted to make sure we talked about is that the government said you have to choose. You have to choose. Are you going to take actual or are you going to take mileage? So let's talk about that. All right, guys. So there's two different ways in which we can write off a vehicle. There's actual and there's mileage. Actual is all the actual expenses that most business owners think about when they have a car, which includes your car payment. It includes your car insurance. It includes the gas. It includes any maintenance that you might be doing on the car. It also includes any tires and any repairs that you need to make on the car. Actual expenses are typically monthly, and you can figure out your actual expenses month over month. So let's just say that my car payments, my car insurance, my gas, my maintenance, my tires, my repairs came out to $1,200 a month. Okay, well, if this vehicle is being used inside of my business, I need to make sure that it's being used inside of my business for more than 50%. 50% or more is the rule. Let's just say I know that my vehicle is being used inside of my business for 50%. Well, then actual is going to give me $600 a month. And then I'm going to be able to take that over the course of 12 months if I'm using my vehicle for all months of the year. And now I easily have my tax deduction right here. So if I have $1,200 a month in actual expenses between my car payment, my car insurance, my gas, my maintenance, my tires, but I know that I'm using my vehicle 50%, that means that I'm going to be able to take $600 a month over the course of 12 months is going to give me a $7,200 tax deduction just off of the actual expenses that I have with my vehicle for having my vehicle 50% in use. If I had my vehicle 100% in use, that tax deduction would all of a sudden jump up to $14,400. Not including depreciation. Now, this is one way in which we can take a vehicle write-off. The other way in which we could take a vehicle write-off is also in mileage. Mileage is very simple. Mileage is just the amount of miles that you're driving in the particular year. Many business owners just don't take it upon themselves to actually track their mileage. I am encouraging you to download Mile IQ, some type of program. Even QuickBooks, I believe, has a way for you to track your mileage so that you're tracking your mileages that is business related. Now, we just learned that the government's going to allow for us to be able to take 62.5 cents per mile. Okay. Let's just say I drove 15,000 miles in the year. Well, I'm going to need to take 62.5% of the miles that I drove to know what my tax deduction is. So if I were to take 62.5% of 15,000, that gives me $9,375 in mileage. Okay. So this is the first tax deduction that I'm able to take for my vehicle, is actual versus mileage. This is decided by the taxpayer. Okay. All right, guys. So now that we understand a little bit more about actual versus mileage, the second step that we have to understand is how does the government view our tax deduction for our business? The government views the tax deduction based on whether or not the deduction is ordinary, necessary to the business owner in the pursuit of income. Which means that if the business owner has a personal vehicle that they were using for business, even though they haven't specifically retitled the vehicle in the name of the LLC, they are able to use 100% of that vehicle for business, or whatever percentage that is business use, as long as it's more than 50%. If the vehicle is financed, you are able to take depreciation, and depreciation is you recouping the vehicle's purchase price over the course of time. Now, what we're going to do is we're going to break down how a purchase price works. Let's just say that we have a vehicle that we purchased for 50 grand. We're going to talk through how a $50,000 vehicle purchase would work on our tax returns year over year. So when we look back here online, it says, while fuel costs are a significant factor in the mileage figure, other items enter into the calculation of mileage rates, such as depreciation and insurance and other fixed and variable costs. So this part right here is the most important part to me as a business owner, because this is the part really that's going to drive home a big tax deduction for you that you don't really have to track as much. Most business owners who have business vehicles are choosing to depreciate their business vehicles inside of their business based on the percentage that's business use. So in this example that I have, I don't have the cars I'm not showing any of the car's value in this example, right? All I'm showing is what if I had car payments, car insurance, gas, maintenance, tires, repairs that totaled up to $1,200 and the vehicle was used 50%. I'm just going over what my deduction would be on actual. And then if I were to drive 15,000 miles at 62.5 cents, what my deduction would be on mileage. But I haven't talked about what the purchase price of the vehicle is yet. These two tax deductions that we have just covered are on top of depreciation. That's on top of what you paid for the actual car. So now we have to factor in depreciation. When we factor in depreciation, I want you to know that cars are depreciated over 5 years. No matter if the car weighs over 6,000 pounds, no matter if it weighs under 6,000 pounds, no matter if it's a Lamborghini, no matter if it's a Porsche. 5 years is the amount of time a car is depreciated if you are not leveraging any type of tax strategy, okay? So if I didn't pull the trigger on any type of tax code like code section 179 plus bonus depreciation, if I never pulled the trigger on any of those tax strategies, my car's value, whatever its value is being written off over the course of 5 years. That means that if I had a $50,000 car, that I can expect to receive $10,000 in my first year, I can expect to receive $10,000 in the second year, $10,000 in the third year, and the fourth and fifth would follow. By the fifth year, this is the purchase price. By the fifth year, my vehicle is fully depreciated. So what does that mean? What does it mean when your vehicle is fully depreciated? What it means is you have recouped the entire purchase price over the course of 5 years. And the government understands that. And if you would like to, you're more than welcome to trade in this vehicle for a new car. But I want you to understand something when it comes to vehicles. If you decide to sell a business vehicle, you're not going to just pay taxes on the profit that you received for selling the vehicle. You're also going to pay taxes on the depreciation you took while you were using the vehicle for business. And that part right there really, it stumps a lot of business owners because they're like, oh man, but if I bought the vehicle because I wanted to wipe away my taxes and I want to sell it next year, you mean to me I'm just going to pay those taxes all over again? You absolutely are. You absolutely are. So this is why I don't look at buying cars as like the biggest tax strategy. It's not really that smart of a tax strategy to just buy cars, right? It's a useful tax strategy when you need the vehicle and can place it in use. But it's not a useful strategy if you don't need the car and you really don't want the car. And best believe, Karlton has ran into customers that were told to buy G-Wagons, and then the next year they're like, dude, I don't want this car. Or people who bought Range Rovers or Denali's and they're like, dude, I need to downsize. I don't need this big ass car. I don't even have kids, right? So what happens when we get into this situation? We just need to be mindful of what deductions we have working for us and how the tax codes are aligned. Right now, we just talked through the fact that a vehicle is written off over the course of 5 years. But if we decided to, we can take code section 179 plus bonus depreciation to write off a vehicle that we know that weighs over 6,000 pounds all in 1 year. We can do that. We can do that. But the rules are around this is that the vehicle has to weigh more than 6,000 pounds. So that is the rule for being able to take a vehicle all in 1 year. It has to weigh more than 6,000 pounds. We talked about at the beginning of this video that there are 3 steps to follow to make sure that you take a vehicle tax deduction. The first step to know is understanding the difference between actual and mileage. The second step to know is knowing that a vehicle, no matter what type of vehicle it is depreciated over 5 years, which means whatever your purchase price was of your car, you are also able to take that purchase price as a tax deduction over the course of 5 years. All right, guys, so now that you understand that the vehicle is broken down over the course of 5 years, and this deduction is you recouping the amount, the third thing to understand is what should you take? Actual, mileage, depreciation, which one? I want you to understand that when you decide to write off your car, mileage and actual is up to you to decide. Depreciation is taken automatically. When you file your tax returns, your tax accountant or the tax software that you use is going to ask you for your business vehicle's year, your business vehicle's make, and your business vehicle's model. Those 3 items the IRS does care about being on the tax return because we can look up your vehicle's year, make, and model to know how much your vehicle was worth based on the time you placed it into business service, because you're only able to write off the vehicle based on what it's worth at the time in which you started using the vehicle, not 30 years ago when you bought it, or 10 years ago when you bought it, or even 5 years ago when you bought it. It's based on when you decided to put it into business service. So whatever the value of your vehicle is at the time of you starting this business is the amount that we get to write off for depreciation purposes over the course of those 5 years. That's extremely important for us to know. Now, the second thing that we have to know is that we need to be better stewards of tracking actual versus mileage. The reason why I say this is because at the end of the year, you have a choice of taking actual versus mileage in excess of depreciation, in excess of what's already given to you. So it's up to you to decide which one is going to be a better benefit to you. I as your tax strategist won't know that answer, and you as a taxpayer won't know that answer if you're not documenting and tracking both. So to be the best steward of your finances and be the best steward of being a business owner who wants to take a vehicle deduction, it is greatly advised to track both your mileage, which is pretty easy if you have an app such as MileIQ, and it's very advisable to track your expenses that do touch your bank account. The expenses that touch your bank account, whether it's inside of your personal bank account or your business bank account, is your car payments, is your car insurance, gas, tires, and those items that we have categorized as the actual expenses. If you are tracking those actual expenses month over month, at the end of the year, you would be able to add up all your actual expenses to know exactly how much you can receive in a tax deduction based on the percentage of your vehicle being in business. And on the contrary, you can also take the mileage if you were tracking it to see, based on the amount of miles that you drove, how much it's going to provide you in a tax deduction. When you have these two numbers, you as a taxpayer can choose the one that gives you the best tax benefit based on the goals you have to reduce your overall tax bill. And that's what we're here for, being able to save money in real time with information. If you guys enjoyed this information today, I'd love for you to do something for me. Share this with another person that you feel like would find value from this video. And take it upon yourself to join our tax-free wealth challenge below. This challenge is going to be absolutely amazing. It's going to be 5 days where I could spend with you going over advanced tax strategies broken down on my iPad in an hour format. And for those who choose VIP, I will be able to help you implement your strategies during our time together. I look forward to seeing you guys at the challenge. If I don't see you there, I'll see you on the next video. Peace.